welcome to this special show. 2015 has been a very difficult year for the Indian economy, for corporate earnings and for the stock markets. Will 2016 be any better? That's the question I put to a veteran panel of economists, bankers and investors at the AIBI Annual Summit. And here's what they had to say about the year to come.
The first mistake that I think the markets seem to have broadly made is miscalibrated expectations. I think you had a patient in the ICU, you expected the patient to come out and start, running a marathon. That doesn't happen. There's a gradual, there's a period of repair that happens, which is, I think, what we've been going through. And let's not forget that repair did have some tailwinds, i.e. in the commodity price side, but it also had some headwinds because of everything that was happening on the export markets, and the commodity price decline also impacted segments of the Indian economy. So I think there was a lot of noise in the last 18 months, and so I think the expectations that 2015 would have been a banner year were, in my view, misplaced. Our own view going into 2015 was that 2015 would be a very tough year, but would set up the foundation that the government did the right things, mainly on repairing its balance sheet for 2016 and 17. And I think we are very pleasantly surprised by everything that we see, whether it's what's happening on the fiscal deficit, which is managed by the government, overall impact on the current account surplus, which we have been running, the way the Reserve Bank of India has been building its reserves. I think with all of that, you're setting up the stage for what should be a very, very strong rally. There is no reason why we should not have one.
Okay. Pranjul, I think you all have just put out a report recently saying only 50% of the GDP has actually effectively done better, and half the GDP is not performing.
Yeah, that's correct. So, because nobody believes the new GDP data, we try to look at about 25 to 30 activity indicators and we map them to different sectors of the GDP. Now, what we find is that about 50% of GDP is improving, but the remaining 50% is still not improving. Then we actually probed a bit more on the 50% that was improving, and there we found that about 35 percentage points is improving because of the oil bounty. So, manufacturing sector, urban consumers, public investment, they fall in that 35 percentage point. And 15 percentage point is improving because of government action, both on any reforms that they might have done or the fiscal stance that they are running.
Only 15%.
15.
And would it be fair for me to say the oil bounty has pretty much sort of run its course?
That's correct. So, that's what I was coming to, that we've had two big drivers of growth this year, and both of them will probably not be as alive and kicking next year. Most of the benefits of oil prices falling from $110 to $40 per barrel have already accrued. We've already, benefited from them. And the savings on the oil subsidy bill by the government, which it could then very deftly move into capex, that has also happened this year. So basically 2016, in my view, and I'm sorry for that, I think it's going to be a tricky year because it's a year when we have to smoothly change drivers of growth. Now, I don't want to sound like a perma bear. There are a couple of drivers out there which look exciting to me. For example, consumption demand, the remaining of the monetary transmission that we may see, and as you were saying, FDI, which is probably the most growth enhancing form of inflows a country can have. So these things are there, but I think at best they can in some sense cover the gap that the drivers of 2015 will leave, and in my sense growth will probably be more flattish than something which is much higher than what we've seen in 2015.
A brief follow-up question: are you seeing green shoots and revival in consumption? Not yet.
The problem right now is that urban India, I'm seeing some green shoots, but in rural I'm not. And what the last GDP data suggested was rural was more than offsetting the urban gains. We really need to fix that.
And much of that, some of that at least, is dependent on the weather gods to some extent. So,
to weather gods, but a lot more on things like infrastructure than people imagine. Rural inflation is still at about 6.6%. Urban inflation is closer to 4%. There's this huge urban-rural inflation divide. So it's like a double whammy for rural Indians. Their nominal wage growth has fallen and they are experiencing higher inflation. So, their real wages have really declined.
Okay, Ridham, answer all of the questions that have in some sense come up, but also talk about corporate earnings, because unfortunately we've seen no relief in that at all.
Yeah, I'm doing that. So firstly, on why economic growth disappointed. So I think two things. I mean, we're simplifying all this, so bear with me, but it's more complex, obviously. So the two simple reasons are, one, I think we underestimated the extent of fiscal tightening. Let's think about this for a moment. In May 2014, when this government came in, the fiscal deficit was circa 6 point something. So it was over 6%. Today we are running at 3.7. This is probably, in my memory, the stiffest tightening that we've seen in such a short span. It has taken its toll on the economy. Of course, it has given us the benefit of greater macro stability. Therefore, it's given confidence to the central bank to cut in front of the Fed. We benefited in a lot of ways. The point that I think you made about FDI, it's not just come to us like that. It has come because we have achieved macro stability, but it has come at the expense of near-term growth. Now we are set up for better growth, but I would say that we underestimated. This government is on track to beat its fiscal target for the second year running. That hasn't happened in a long time. Governments have only missed fiscal targets. So again, that tells you that they are doing better than what they had also actually anticipated. The second is global. I mean, just think about it. Global trade has collapsed. Who thought about the way it has collapsed? I mean, nobody's forecast had such a big collapse in global trade. And even though India is a largely domestic economy, it's taken toll on India on an absolute basis. That's why our absolute growth number is lower. We are still better than the rest of the world, but we are lower on an absolute basis. So that explains economic growth. Now, earnings. So I think the single biggest factor in earnings is the deflation in PPR. Okay, real growth, assume it's 7. I think it's more like 6. It has still halved. It is still, when growth was 7% in the last decade, nominal growth used to be 12%. Because we had a 5% GDP or a 4% GDP deflator and 7% real growth. Today, arguably, the GDP deflator is in negative territory. So 6% real growth, 5% nominal growth. So India is not experiencing anything like what the real growth number suggests, because there is no nominal growth. And earnings is a nominal number. And if nominal growth is weak, then earnings will be weak. So margins are actually improving, but revenue growth is falling. That is why corporate India has actually reported a 5% compression in revenue growth. And when your revenues are going to fall 5%, it's hard to actually have positive earnings growth. So I think that's the single biggest factor which explains why earnings have missed. And you spoke about the markets as well. Emerging markets are finishing this year as the third down year. That hasn't happened to EM in a long time, since the EM asset class was invented. And guess what? This year, EM asset class is down 25%. I think we've gotten away with a double-digit fall, 10%. So we can't take returns out of context.
But do we run the risk of feeling that way about 2016, right? Especially, and let me tell you why. I think Pranjul referred to the quality of government expenditure next year onwards. A sort of a shift in balance that they managed to do this year, which they may not be able to do next year if they want to keep their eye on the fiscal deficit and fulfill the pay commission requirements and fulfill the OROP. So I'm curious about how you look at that. I'm also interested in looking at what you think of a revival in global trade. Exports, 9-10 months of degrowth in exports. Do you think that 2016 is going to change any of that dramatically? And if not, therefore, can it be a better year than 2015?
So no doubt it's a low return environment as we characterize it globally. It's not an easy environment for making money outside India. I think India has got its own unique set of opportunities, and it can actually do okay. I think the government is doing quite well on infrastructure. So I think the quality of spending actually is improving, not deteriorating. And that could be one big driver.
Can it sustain?
Menaka, the tax collection of the government are running at cycle lows. So if they even improve slightly, they will get so much more flexibility on the fiscal side, it will surprise us on the upside.
And so again, those tax collections are dependent on two things. Consumption moving up, corporate earnings improving. You haven't painted a very pretty picture of either. I'm not challenging any of the
we were talking about what happened. What is going to happen is slightly.
So therefore, is any of this going to change dramatically in 2016 for it to be a better year?
I think corporate earnings are turning already.
Already?
Yeah. Okay. So I think the next 2 quarters will be very strong in terms of growth. in corporate earnings. So I think this quarter is already going to be good. So I'm actually quite bullish on 2016. I would share Amit's view, I would share Nilesh's view. I think 2016 is going to be good.
Nilesh said January 2017, just to correct you.
Well, he meant the calendar year of 2016, and when we come back and measure it in Jan, and I think you meant 1st Jan, right? So, so basically the calendar year I think should be good for equity markets. The risk factors obviously are there, that the world has got anemic returns, and therefore India has to fight those anemic returns to deliver its own absolute return. But I think corporate earnings are on the mend. I think the government is doing a fine job of balancing fiscal spending. Infrastructure spending I think will be quite strong. Where I think we will have weakness and continuing weakness is capex from the private sector. So I don't think that's improving. We just finished our proprietary survey of India's top 200 companies. They are telling us that they are going to, on the aggregate, that they're going to grow capital spending by 10% next year. And I think that will be a pretty dull number. And they are in fact guiding us to this dull number even for the subsequent year. So right now sentiment in corporate India is weak. So capital spending I think will be a little weak, but the government will compensate. I hope that global trade stabilizes because we've seen a lot of damage. But as I said in the opening remarks, it hinges on China rather than the US. So if China shut down 15% has announced that it's shutting down 15% of its non-ferrous capacity. See, these are important things because they will stabilize the global commodity markets. And I don't think India wants commodity prices to fall further. It's not good for us. If oil goes down more, it's not good for us. We get more than $30 billion of remittances from the Middle East. We have tons of people working there. We don't want oil to fall further. Saudi Arabia is closing this year with a 22% fiscal deficit. We can't.
Who would think of that?
Yeah, so if oil falls further, it will lead to job losses, it will lead to remittance losses. It won't be so good for India. So I think India will be better off if oil actually goes to 50 than 30. And likewise commodities stabilize, and I think that will probably mean that global trade stabilizes. But that obviously is a risk factor which we need to keep in mind. But I think 2016 certainly looks better for growth overall, for earnings growth as well as for stock market.